And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Our topic today is a pretty broad one, market valuations and whether presidential elections really matter for the markets. Our guests, two big heavyweights in the finance world, Nobel Economics Prize winner and Yale professor Robert Shiller, joining us, and Ed Clissold. He's the chief U.S. strategist for Ned David Research, and he's done research on elections and the impact on markets going all the way back to 1900. Gentlemen, thanks very much for joining us. Professor Shiller, I just want to pick up on our discussion earlier about your New York Times op-ed where you said you were concerned about the potential high prices in the market. Can you tell us what's concerning you right now about the prices and whether or not that's impacted or related to COVID?
I think we have to look at what people are thinking, not necessarily what they're talking most actively about. So 30 years ago, I started surveying both institutional and individual investors. And what I've discovered with our latest results is that among individual investors, the assessed likelihood of a crash is at, like 1929, and that's a famous narrative, is at about the highest it's been. It is the highest it's been. Or in other words, my crash confidence index is at its lowest since it started out in 1989. So I'm worried about that. They also think the market is, the valuation confidence is low, especially for retail investors. But it's true for institutional investors as well. They're on the low side, both crash confidence and valuation confidence. So that puts me wondering, what frame of mind are we in now? Yeah.
Yeah. I know I remember we had a long discussion back in we had a long discussion at the end of last year about your book on narrative economics coming out. Are you sort of suggesting here that because the fear is very high that people can talk themselves into a market crash? I mean, what's the implication for people having a market narrative in their head that the market could crash? Because the market did have a pretty big drop, 30%, just a little while ago, and we sort of went through that, and the markets are back with tremendous stimulus. Is there something that's concerning you now with this narrative that people have in their heads that somehow they could wish it to happen?
Yeah, that what happened between February 19th and March 23rd was the embellishment of a pandemic narrative, and the word depression, talk about the Great Depression. Now they sound like very different things, but for a while at least we thought they were similar, and so maybe that's passed. I'm not counseling pulling out of the market. I'm not being alarmist here, but I'm thinking that there might be some rough riding in the long run. It is the most expensive market in the world, but it does still have a excess return compared with alternatives that is pretty substantial.
Yeah, you have a long history of warning about high-priced markets. You became very well known for that first edition of Irrational Exuberance, talking about high stock prices, and that came out right as the market was topping out in the early part of 2000, as I recall. Then you talked about high real estate prices, 2004, 2005. Prices did top out. One of the issues that I have, though, is relative valuations. You talked about high bond prices a few years ago, and I think it was the third edition of Irrational Exuberance. And prices are remaining high for bonds, and yields have been remaining low, and it looks like they're going to remain low for years. So is it not unreasonable to suggest that the stock market, given the demand for stocks, is reasonably valued compared to bonds at this point?
Well, I don't know what reasonably valued means, but yeah, I'm advocating investing in stocks. So I'm not. This is not a doomsday scenario for me, but I think that it's interesting to note that it is a time of exceptional uncertainty as I've measured it, and I don't have the ability to say what that necessarily means. It could be a contrarian indicator, and it could mean that it's a good time to invest. I think you have to, the market is very complicated and it depends on the interaction of multiple narratives. And so I think that the mindset that people have today is a bit fragile. And the election coming up is in the works. It's creating a sense of dread, which there's something that psychologists call the affect heuristic. That when you're worried about one thing, you tend to be worried about other things as well, if they don't drive your attention away. And if there's another shock downwards, I think there could be a reaction among other investors. And I'm pointing out as a possibility, not at all a certainty. But the stark reality is that people are fearful that this is 1929 again. I'm not making that up. It comes from my surveys, and they think the market is highly priced. This is a bad combination. It could be a bad combination, and I don't know the certainty what the future will bring. I think people should be aware of that and not over-focused or overexposing them to say information technology risks.
Yeah. Ed, why don't you weigh in here? You're the chief strategist over at Ned David Research. What do you think of what Professor Shiller is saying? Is this a bad combination that we have here with high prices and high anxiety levels, essentially? And what's your view on what's going to happen in the next few months?
Yeah, if you're talking about valuations of the market, I think one of the challenges is trying to anticipate when earnings are going to come back. I think most people accept that their earnings are depressed because of the pandemic. Right now, consensus estimates are calling for S&P 500 earnings to hit a record high next year. And if the economy reopens, it's reasonable to think that could happen. But if for the pandemic or other reasons that doesn't come through, then we're left with really high valuations and not much earnings growth. And so that's probably somewhere, somewhat behind the anxiety that Professor Shiller is talking about.
So I mean, obviously what happened last week is a manifestation of what you were talking about. I mean, since 2002, the narrative, as Professor Shiller would say, the narrative has been that 2002 was the earnings bottom, 2003 was better, and 2004, Q2 was the bottom. Q3 earnings have improved dramatically. We see that already. And in Q4, they're going to get even better, and even better in Q1 and Q2. And suddenly we're going to get a vaccine, and it's all going to be a party at that point. That seems to be the market narrative. It was interrupted last week when all of a sudden it became clear that the reopening narrative is not going very well, that we're not slowly marching towards a reopening and there will be stimulus, additional stimulus as a bridge to the vaccine. Both of those narratives, the stimulus and the reopening story, kind of got interrupted last week, and the market had a bit of a hiccup. And do you think those will be resolved? If you look today, the market seems to believe that there's going to be more stimulus because all of the stuff around stimulus is doing better today.
Yeah, last week was an interesting dynamic because small cap stocks held up fairly well. Bond yields stayed fairly firm as they didn't go down. Usually, this was a complete risk-off move last week. Small caps, which are more volatile than large caps, they should have gone down. Usually, investors go into risk-free assets or close to risk-free assets, so treasuries. And so that didn't happen. So it was an odd mix last week. So the way we interpret it is that investors expect that eventually they're going to get a deal done. Eventually, we're going to get through the pandemic, but is that going to happen right away? And it doesn't. That was, I think, part of what happened last week. But yeah, I think the expectations had gotten to the point where, hey, this is going to work out fine, and then maybe not as well as we had thought. And I think the other element, to bring it back to earnings, is that in Q2 expectations were so low that it was the best beat rate. That is the highest percentage of companies in the S&P beat consensus estimates ever. This is going back about 25 years worth of data. And so coming into this quarter, even though earnings have been pretty good, they haven't been as good versus expectations, and that probably put a dose of reality into investors as well.
Yeah. Before I move on, Professor Shiller, I just want to get your thoughts on bonds because we sort of half finished that discussion. Yeah. You've also warned about high prices of bonds for a number of years. Bond prices are still high. I'm wondering if you see any change in that at all. It's hard to imagine somehow bond prices dramatically coming down unless there's some dramatic inflation shock. Do you have any idea or thoughts about what bond prices might be doing in the next couple of years?
Well, bond prices have mattered very much for the stock market in certain episodes. I'm thinking of the 1981, 82 recession, stock and bond yields. You might have thought back then, that they'll never go down. Bond prices will never go down, but I'm sorry, bond yields will never go down, but they did. So when with my recent paper with Farouk Givraj and Lawrence Black, we look at how a spread between the inverse CAPE or the CAPE yield and the 10-year Treasury has explained returns. It does explain excess returns between stocks and bonds. So it looks good for at the present time because interest rates are so low. And this kind of analysis takes account of both of the possibility that that bond prices will decline in the near future, and just the spread between bond and stock returns. So yeah, I think for a long-term investor, it's not bad. It's not as good as it's been, the outlook relative to bonds. But bonds are certainly at an extraordinarily low yield right now, and that has to be affecting investors. It's not the only thing at all, but it's part of the narrative that's driving, has kept stock prices so high. But it lives along with this other narrative about 1929 and about how stock prices were so high and people didn't believe it. Many people got crushed in the 1929 crash. And that's still there. It's still on many people's minds. It's like a folktale that they grew up with, and they're reminded of again now.